David?
Mic check. Yeah, we're good. Yeah, I think we're live, Josh. It's 9:30 a.m. May 23rd.
The very first Java with Josh.
We did it. We were a little stressed, but we made it.
I don't get nervous for presenting very often, but as you have attested to this morning, it has had me kind of up in turmoil with getting ready for today. So,
which I find hilarious because I am like super calm and collected. Whereas when I like give introductions at your workshop or even during our podcast, I'm like a sweaty hot mess. Right now, I'm like, let's go live, baby. What are you gonna do?
Well, I feel like I only have half an hour to try and give some decent content and some educational material to people,
Sure.
and I have you sitting by my side.
Yeah.
So,
wait. What does that mean?
Well, let me get in there. So today is May 23rd, 2023, and this is the very first Java with Josh. So who we are? Cheers. I'm Josh. I am the owner of FSR Wealth Strategies, a retirement planning firm that Dave actually helped come up with our mission statement, giving you the confidence to make retirement the best part of your life. And this is my good friend, Dave. We played high school basketball together, and that's about the limit of your financial background.
How does that relate to basketball?
Nothing.
Oh.
It doesn't. But that's how I know you. I guess that's where I was going from. So before we get started, we have our chief compliance officer sitting in the room with us, and he wanted me to put up a disclosure slide.
Sure.
Do you have that for me,
Yeah,
Dave?
we can do that really quick. Yeah.
So what this is pretty much telling you that what you're about to see and hear is for your information only. It's not considered advice, but anything that you do want to discuss further and want advice on, we'd be happy to help you. So just give us a call.
All right. How long should I leave us up?
That's good. You're good.
Yeah, I didn't think
no one really wants to read that or see
I didn't
that.
think so. Yeah, kind of hurts eyeballs. So.
So Dave,
yeah,
what is this? Why are we here?
Well, Josh, we have been ramping up our opportunities for people to hear you speak. We do our podcast, which is bi-weekly. We do our quarterly client events. We have our workshops at restaurants and libraries, and that's all great. But I don't know. There's one consistent thing in my life, and it's everybody I see, they say, I want more Josh.
So you're not talking to my wife.
No, clearly not. So I said, okay, the people want more Josh. What can we do? Well, let's do a live show because there's like added pressure on both of us to get everything correct. Technology, get your little market updates, get all my stuff on the computer right. And so I'm like, yeah, let's do it. Let's put some pressure on. And Java with Josh is going to be a monthly live show, 30 to 45 minutes. Probably on a Tuesday later in the month.
Maybe a Wednesday because the next date I picked is a Wednesday.
Oh, sure. So you picked a Wednesday next. Sure. And it's going to be pretty casual. It's going to be a 10 to 15 minute, very topical market update from Josh, whatever's happening in the market. And then we are going to do a combination of live Q&A for whoever's watching live. You can post questions in the comments along with pre-submitted questions from people that wrote in prior to us going live. Now, I will say this. If you have a question, and you're in live chat, either YouTube or Facebook, please put a capital letter Q before your question. So Brian and I know that it's in fact a question, not just a comment. So Java with Josh, man, that's what it is.
Ooh, I like it.
Yeah.
So this worked out really well to schedule this in what is our kids' busiest time of the year. We're at the end of school right now, and schools, I think, take everything they're planning to do for the last quarter and put it into 2 weeks.
Yeah.
And so you and I actually haven't seen each other in 5 days. We've been trying to pull this together. So let's hope for no technical difficulties or that I don't stumble over crazy words there.
Yeah, let's hope not. And by the way, Erin is not happy that you waited till the last minute. She's very upset with this.
You'd figure after this long a time, she'd get to realize that that's how it happens here.
Don't kill a messenger.
So let's get into some fun stuff here.
Yeah, fun stuff.
And what we're going to go through is some timely market information, but this is kind of my take on how it applies to retirees and how it applies to our clients. But with everything that we talked about, we spend so much time talking about the importance of planning and the big picture, the long-term approach, and really taking your personal situation into consideration. And some of these things are things I'm going to pull out of the news, and I'm going to try and put them into context and how they apply to your situation. But remember, this is a very short-term talk. This is something that I'm talking about today, May of 2023. It may have 6 months on either side of this date of relevance, but after that, the planning is going to take over, and no matter what happens, that's going to be the key here. So anything that we're talking about today, if you have questions on it and how it relates to your specific plan, let us know, because that is the most important part, is how it applies to your specific situation. So Dave, if you could go to my iPad here really quick.
Yeah, first, Josh, I want to make you feel good. We have a first comment from Mr. Pradeep, and here's what he says. He says, "Hi, Josh. You guys look very relaxed. Java hasn't kicked in, I guess."
Yeah, Pradeep, you know what? Dave wouldn't let me have any Java till 9 o'clock this morning, so that would be it. So
this
thank
is
you.
true.
Thank you. So
all right, Josh, your iPad and you are up on the screen.
Well, this last year, 2022, was really kind of the first, actually end of 2021, 2022, was the first really down year that we have had in this market since 08, 09. We have had an unprecedented growth. And it got people feeling really comfy, really kind of the greed set in, and this mindset of nothing will ever go bad started to creep in. And all of a sudden, 2022 woke people up. And but since October of 2022, we've seen some really big increases. And this, what you're seeing here, is just a graph of the increases from 2022 to 2023. So as everyone knows, the market goes up and the market goes down, but it's a matter of how it applies to your situation. So let me go through a few things here. First off, I want to talk about some economic indices, and the data in here comes from April 30th, so it's a couple weeks old here. But as it's reported here, I want to go through a few things. The red lines that you see here in the middle, these are normal. This is their average normal range. This is kind of like when you go to the doctor and you get your blood test and they show you, where you fall in that normal range. And some things scare you, and because you're like, oh, I'm outside of normal. And then your doctor goes, oh, no big deal. They don't even bring it up. And you kind of question it and drives you crazy. But anyways, over here we're seeing consumer sentiment, and it's going back from 1978. And what you're seeing is actually a decreasing consumer sentiment. Consumer sentiment is people's thoughts on the economy, their purchasing powers. I mean, it's a strong part of our economy, but it is below normal. It's actually decreasing. That's something we don't like to see here.
And that's opposite of people's sentiment towards our podcast, which is like
increasing all the time.
Tenfold.
I mean, even
day.
More than just our moms.
Yeah, it's true.
So
Brian's mom too.
Yeah. So, but then we go into these other economic indicators, and people talk about what a terrible economy we're in right now, all that stuff. And if you look here, GDP came in over at 1.1% for the quarter, and back to 1947, that falls right into our normal range. Inflation is actually coming down. It's been high. We're going to talk about inflation here a little bit. Volatility is one that I'm not liking to see. You're seeing volatility increase here. Volatility is going up. It's at the high range. Volatility, especially for retiree, is something we really try and monitor. Unemployment, this has been in the news forever. If you're following the inflation news, unemployment is still at historic lows, and you're starting to see treasury rates fall a little bit. Now that's new since we've seen over the last 12 months. But these are economic indicators, and the economy is a little different than the stock market. The economy is kind of what's going on right now. And as Ben Sullivan from AE Wealth talked to our clients a few weeks ago, as he said, the stock market quite often is looking out 6 months ahead. So it's predicting what the economy is going to be 6 months from now. So as we're going through here, make sure we understand the difference between the economy and the stock market. So now what I'm going to show you here, I'm going to show you some predictions. I'm getting a crystal ball out here. Everyone always asks for our crystal ball, and I always say my crystal ball is no better than anybody else's. And what we do is we read a lot of research. And this comes from Lincoln Financial Group. Lincoln's a large insurance carrier. And on a fairly regular basis, they go out to these money managers over here you see on the right, these guys over here, and they ask them questions. They get a lot of research from them. These are some of the largest money managers in the world. And they kind of see, what are the experts thinking? What are they seeing out there? And here's one of my favorite things to look at. These are the survey results. And there's a few interesting things in here. One is they're looking at inflationary pressures. And what they're seeing here is the vast majority of the respondents actually think we're going to see declining inflationary pressures, declining 3 to 4%. That's a pretty big decline over the next 12 months. They also are seeing that they are predicting a recession. They're saying over 50% think if we go into a recession, it'll last between 6 to 9 months. What they're looking here, though, the one everyone always wants to know is market performance. Excuse me. And specifically the S&P 500. And they're pretty split across the board. 25% think we'll see a decline of 5%. 38% think we'll see a decline of 1 to 8%, and 37% think we'll see a gain of 1 to 5%. So, like any good crystal ball, no one has an exact answer. Now, what everyone does agree on is that there's not a gain of greater than 5%. So that's kind of interesting here, and they're showing earnings down below. So the part on the right, I'm going to kind of skip a little bit. This has to do with the Fed's rate, and the Fed has actually changed things since this survey has come out. So we're going to go through that a little bit here, but let's talk about the Federal Reserve and interest rates. Dave, you've zoomed in a whole heck of a lot here. Mm-hmm. But the Federal Reserve has completed a interest rate increase over the last year and a half. And this actually comes from last March. You can see it has gone pretty much straight up. It's been the quickest interest rate increase in history. And the reason they are doing this is specifically to kind of chill the economy out, to chill out inflation. Now, I always laugh because the inflation was government created when they put the stimulus in place back through the 2020 pandemic. They added a ton of money to the economy. But what's happening now is they've tried to cool inflation here. So let's talk about what's happened here. You can see last year we had an increase in inflation rate. This was when people were buying those I bonds, and they were getting 9% on guaranteed government bonds. But inflation has continued to come down. Now, inflation is still relatively high compared to what people are used to. I tell this story a lot in seminars. I graduated from University of Illinois in 2003, and based on my finance classes, I thought I'd be talking about inflation every day of my life, and it really wasn't until 2021, 2022 when we started talking about it. So inflation has started to come down, but you can see it is still high. It's still there. Now, looking forward, this is what their expectations are into the future. So we do see a continued decrease of inflation. Now, what does this mean for interest rates? What this means is that we actually think, oops, sorry, went too fast ahead there. What they think is we're probably at a pause for interest rates. In fact, at the May Open Markets Committee, which is the Federal Reserve that sets interest rates, they actually talked about a pause for the first time. They changed their verbiage a little bit, and that had markets get really, really excited. So we'll see what happens into the future. There are a lot of people predicting rate cuts actually into this year. And when you talk about why people would do rate cuts, they're going to do rate cuts because inflation has gone down, or the economy has gone down, spending has gone down, or I should say corporate spending has gone down, and or corporate earnings, I should say, has gone down. And they're going to try and increase the economy there. So we'll see as the year goes on, but these rate cuts do play a big role into what happens with our stock market. So now also with these rates,
Josh, I think you need to take a sip of coffee here. You are talking a lot. Take a quick little breather.
I also feel like I'm going really fast.
You are talking fast, but that's okay. Oh, we have a note from a listener saying, Josh, please slow down a little bit. Hey, we're live, buddy. This is going to happen.
It is.
Yeah.
And, I wanted this to be really current.
Yeah,
so
sure.
Actually, an hour before this, I was actually pulling additional slides together.
Okay.
So it was kind of one of those things that as I'm talking, I want to make sure I can fit all this fun stuff here, because
it's a fair point.
I have one question that I haven't gotten to yet, and I think it's going to be the key question. It was the most asked question as people responded to us.
Okay.
So I want to make sure we left enough time at the end for that. So
absolutely.
But I'll slow down because the next part here, I think, is actually a big thing. Short term, and we just talked about the Fed raising interest rates, and short-term interest rates have skyrocketed. Short-term interest rates have gone up. And what does that mean? For the first time in really recent decade or more, we're seeing decent CD rates. We're seeing treasury rates, paying 4 or 5%. We're seeing bank accounts, money markets start to pay good interest rates. So what happens is, especially in a retiree's mind, is they start thinking, how can I get this short-term rate? How can I increase my savings rate? And they think it's going to be there forever. The problem is it usually is not. And when that occurs, we run into what they call reinvestment risk. And this is something I wanted to go through here. What you're seeing is the growth in money market assets. So money market assets, these are those short-term, usually really, really liquid, safe investments. Now, what happens here, though, is you can see just the growth. Now, this is from 96, but if you want to look here, this is just right here, this starting point. In fact, I'm going to put a different red line in it right here. That is 2020 when that kicks in. So things just piled into money markets, these short-term rates here. And the problem we're seeing is when people get really comfortable, this is when they get hurt. And this has to do with that reinvestment risk. And if you can see below it here, these are the last 3 big peaks. So what we're seeing here is this peak, and this peak here represented in the graph to the right. What you're seeing is the U.S. stock market index compared to those money markets in the following years there. And so, while it may feel really good right now, this poses a risk long term. And as we encourage investors to think long term and make sure that we understand what their plan is, this poses a risk that is, they're not even thinking about. So, and here's what that risk is. This is one of those new slides I put in there. This is absolutely fascinating to me. And what this is showing is the growth of cash. And this might get a little too technical, Dave. I know you love when I overcomplicate everything.
Oh yeah. Wait, should I?
Oh yeah.
Wait. Okay. Well,
for those of you that are
why must you needlessly complicate everything?
There we go. That was Elf, Josh. I just played Elf.
Our podcast listeners, Dave pulls sound effects out and likes to play them over the top of me. So thank you. But this is comparing the risk of and the impact of inflation on people's cash. And if you look here, the spending power, people like to feel good. They like to have that cash. But one of the risks that people don't think about is the cost of goods gets higher and higher every year. And quite often it will outpace the growth of cash. And so, you might feel good because you're not losing money in the stock market, but if you can't buy these things for the same price the next year, it has the same impact as a negative stock market return. So those are something that we want to make sure everyone thinks about.
I've been waiting. You've been waving your arms a lot. I'm just waiting for you to knock over your coffee and just have pure chaos in the studio.
Well, I actually picked the mug I picked today. A client made these mugs for us.
Oh, how nice.
And I don't know if Jane's watching or not, Jane or Tom, but Jane is a retired administrator at Rush. And I love talking to Jane because she truly is passionate about all sorts of things that she does. And her retirement hobby was and still is pottery. And for Christmas every year, she would make me a different pottery of some sort. So we got coffee mugs and platters. And as we redid our office, I said, hey, would you make coffee cups for our clients? And every time you come into our office now, you're getting these water cups, these coffee cups. And I just love them. They're super sturdy. So I doubt I'd knock it over. It's super sturdy.
Super sturdy?
Yeah.
Okay. Yeah. And you're not very strong.
I'm not strong, but I do flail a lot.
Yeah, you are a flailer.
So... but I want to get into that one question that was the most asked question. And it's really timely. It's in the news a ton right now. And that is the debt ceiling.
I don't know why I did that. But
it's...
it is what it is.
It is what it is. The debt ceiling. So let's talk about the debt ceiling, what the debt ceiling is. The debt ceiling is the limit of government borrowing. So Congress sets a limit to how much our government can borrow to spend money on. And every couple of years, they have to raise it. And if they don't raise it, legally, Congress can't borrow money to spend it. And so they talk about the U.S. default of what happens here. And this has happened over and over again throughout history. In fact, I think I saw a note. Should look at it up here. I'm going to lose it here. But of course, here, this is my organization. Last minute, Aaron was right. I should be more organized.
You're always right.
But what we look at with the debt ceiling is what actually will happen and what we think the outcome is. And if we look past, again, long term here, will the U.S. come to a deal on their debt ceiling? Hands down, without a doubt. We can't operate as a country if we don't come to a deal on a debt ceiling. Will it happen before this quote unquote 10 days from now, this June 1st date that they put out there that says we won't be able to pay our bills? Both sides actually say most likely. They were far apart. They're coming closer together. Both sides do not want us to default on our debt. Now, what happens if we do default? Well, there's certain things that we're not going to be able to pay. The question we get all the time is, will I get my Social Security? And the answer is most likely yes. Now, there's a chance that you may be delayed a little bit. There's a chance that they may have to catch up, but I don't see this as an issue at all. And this is also why, as we talk to our clients and we make a part about planning, we want to have that short-term cash. You never know what's going to occur. Now, let's say they don't get Social Security. Will they get it the following month? Yeah, and they're going to catch up everything. But again, I don't think this is going to be an issue in the least bit. Now, will it lead to short-term volatility? Yeah, I think it's going to lead to short-term volatility. I think we're going to see, as we get closer and closer to that deadline, you're going to see both sides use this as a bargaining chip to try and get their point across. We'll see how we'll see what comes to fruition there. But the debt ceiling I see as a very short-term, minor vehicle. No matter what Fox News or CNBC or MSNBC tells you, they're just trying to play up to a story. Economically speaking, if we're sitting here a year from now, you guys are going to forget that we even talked about the debt ceiling this year. And as long as we make good, thoughtful, long-term decisions with it, and we're not, we always talk about the own your retirement planning process. And if you're really, truly owning it, a minor blip like this should have zero impact on people's retirement.
Can I say something I'm scared of?
Yeah, what are you scared of?
This debt ceiling thing. You said June 1st. That's 3 days before.
When Carla
forgot my birthday.
Forgot your birthday?
Yeah, 3 days before my birthday, and you said something that just triggered a fear. You said, we won't be able to spend on certain things. I'm thinking, wait, that's 3 days before my birthday. If we don't do the debt ceiling thing, are you not going to buy me lunch because you can't spend money on it?
Am I out of town? I think I'm out of town on your birthday. I don't think you get lunch on your
You
birthday.
would. Well, Brian, can I use the FSR credit card? Thank you, sir. Hey, Josh, should we move on to some questions, or do you got any closing
let's
thoughts here?
Questions. We have any fun questions here?
Yeah, we do. And so I'm looking at, just so everyone's kind of clear here, it looks like we are kind of having some technical issues with Facebook, and we've not been getting many comments. So these are things I'm going to look into for future episodes. This is our first time, guys, so we'll make all things right in the future.
It's the fun of going live.
The fun of going live. But Josh, we have actually, let me put this, put the camera back on you. And this question comes from Mr. Doug. All right, you ready for it?
I love Doug, and I have a feeling I know how complex this question is going to be.
It's actually only like 7 or 8 words. It says, how do you, see, he's fancy. How do you reallocate, but the re is in parentheses. How do you reallocate or allocate an investment portfolio during times like these?
I think the key to that question is actually times like these. And people like to talk about how this is unprecedented. This has never happened before. And it truly has. This is not something we're seeing for the first time. This goes back to good, solid fundamentals. This is when we try and take the emotions out of it as much as we can. We try and understand that you're going to live your life. You deserve to live your life. And as long as we practice good, solid fundamentals, we have the money that's safe, and we know where we're trying to get to in the future, times like this won't really matter as long as we're planning for it appropriately. And I'm going to go back to something Ben Sullivan said at our last event, and I think it was one of the most profound statements that I've heard. As he said, as a retiree, you have to think about investments a little bit different. And you're not trying to earn as much as humanly possible. What you're trying to do is you're trying to achieve something. You're trying to achieve your dreams of security and safety and have like this retirement that is, is what you've always dreamed of. And what you do is you think about the amount of risk that you're taking, and you try and minimize that. So you take enough that you can achieve whatever you want, no matter what happens, but you're not putting yourself at risk. So what you do is you change your thought process, Doug, and you make sure that you are following fundamentals, and you just do the basics the best you can.
I like it.
So
okay, cool. I hope
that helped there.
Yeah, I have another one.
All right,
let's read it.
Yeah, go ahead.
Okay, this one,
you scared me as you rolled your, flicked your eyes up at me.
I have a good one coming up last here, but so this one may kind of be on the right in the middle of information versus advice. So I don't know how we can do this here, but it comes from Barb, and it is something like, is it worth converting IRA money to Roth IRA if Congress is talking about taxing Roth money in the future? Is there any Roth money passed on to beneficiaries that would be required to pay more taxes?
First off, you gave me a hard time about spilling my coffee. And you
I almost
took it out there, and it would so be you.
It would be me.
So let's talk about the conversion versus non-conversion. And it's really quite simple. Are we going to pay more taxes today by doing it, or are we going to pay more taxes later by not doing it? And we're always trying to pay the least amount. So, Barb, I know Barb quite well, and we're actively tax planning for Barb and her family. And I think people get really worried. Hey, I'm paying these taxes by moving money out of an IRA to a Roth. Now, first off, you want to minimize that, and you don't want to pay more than you have to. But second, and Barb's concern here is once it goes to a Roth, you want to make sure that it's not going to be taxed into the future. And Barb, I saw your question earlier. Dave, I cheated. Dave told me it was coming. And I actually went out and I did some research, and there is very little talk. There's almost nothing out there about the taxation of Roth IRAs in the future. Now, here are some things that, and I've said this in seminars before, what I worry about. I do worry that someday the government will stop letting us put money into Roth IRAs. I do worry that the distributions that come out will have RMDs on it, because right now there's no RMDs on Roth IRAs. And I worry that upon your passing, any Roth money right now has the same 10-year rule that IRAs have, traditional IRAs. I worry they'll shorten that, but the money still would come out tax-free. I do not worry about the tax-free distribution aspect of the Roth IRAs. So
excellent. We have one that just came in from our buddy, Mr. Pradeep again.
Yeah.
All right. He asked, do you have any guess regarding the timeline it may take to recoup the losses of the past few years? Oof, that sounds intense.
Oh, Pradeep.
Wait, do you want me to take this one?
Yeah, Dave, you got this one?
Yeah. Yeah.
Pradeep, that's a great question, and I'm gonna actually we'll reach out offline here, because it depends on if we're talking about the market itself or if we're talking about anyone's particular portfolio, because it has to do with the crystal ball that's out there. And my exact crystal ball is, I think we're going to actually have a decent economy once we get through and kind of flush this turmoil out of us here. Once we get this inflation kind of under control, and once we get our tax fundamentals kind of squared away as an economy, the next in 2026, our tax law is set to change and go back to pre-2018 levels. I think once Congress decides what they're doing there, it's going to have a lot of certainty in our corporate world, which will have a huge impact on that. Now, Pradeep, on the safe side, I'm curious about interest rates as well. Where are interest rates going to hover at, and where are our bond rates going to be like? I do think, and I don't have it here, I'd be happy to share with you, but that those same money managers we talked about before, they do a prediction on where the 10-year Treasury and the S&P 500 is going to be, and what that, they used to call it the Cadillac of investment portfolios, the old 60-40 portfolio, where that's going to be. And their predictions are significantly lower on those 60-40 portfolios than they have been historically. So it may take a little bit longer, and we may have to get used to some volatility that's out there. But managing that, internal for your own situation is truly the key.
Brian, 2 things for you over there. You ready for it? One, is crystal ball, is that compliance approved? Keep saying, okay, good. You can say crystal ball in the future. Yeah.
As long as I don't tell people to live by the crystal ball, we're okay.
Yeah. And then 2, any more questions come in that you saw on your end? No? So I think the last one, Josh, is actually a comment from a fellow called Big Mike in Colorado. Yeah, we've mentioned him a few times in the podcast.
Yeah.
He's grateful for you and I because he no longer needs to take melatonin at night to fall asleep. He no longer needs to take
the dulcet tones of our voice.
Well, no, here's what he does. I was wondering the other day why our 2 podcast episodes on bonds had so many views. That's his nighttime story. It's his sleep story. He puts on the episode about bonds and falls right asleep. So he says, "Thank you for that."
Well, Big Mike, that is a great finishing. If you guys aren't listening to the Retirement Equals Freedom podcast, there is we go into some depth on some different conversations, and there's also more witty banter between Dave and I, which love it or hate it. It's kind of like how people think about you, Dave. Love or hate.
No, like we said before, nobody hates me.
That's true.
I am just
That's true.
A big ball of love or something. Compliance, is that good? I can say that? Cool. So, Josh, high five.
I'm a
job.
little...
You're a little sweaty.
High fives always feel awkward. Well, especially when my hands are sweaty as I'll get out.
I love seeing you nervous.
I think the first half hour went okay. I'm okay with this.
This is a great first session.
Our next Java with Josh, I picked the date. Hopefully you're going to be in the office.
Okay.
I went Wednesday, June 21st, same time.
Sounds great.
And hopefully we'll have all the technical difficulties cleared out, and hopefully we have more people joining us.
Yeah, we ended up having 37 at one point. That's pretty good. Yeah. 37. Oh, times 2. Times 200. Oh my gosh, people went international. This is pretty cool. It's a good thing I didn't name the show like based off of the word Tuesday, like an alliteration based on Tuesday, because that would have been awkward.
That would have been weird. We have to find out when we can do it again.
Yeah.
So.
Java with Josh, Wednesday, June 21st. I will be 43 by then.
Well, you will be. You're getting old.
I'm an old man.
So
all right.
With that, I wish everybody a happy Memorial Day weekend.
Yeah.
And
we will put this replay up on YouTube some point this week if Josh lets me actually do some work.
Sounds
Doesn't
good.
make any sense.
All right. Well,
all right, Josh.
Cheers, David.
Cheers. Java with Josh.